No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. We're going to be talking about a number of things. I found this great article, 22 jaw-dropping stats about retirement. And it was some really interesting things there that I talk about quite a bit with clients, and one of them being, of course, that we're going to be living longer. Well, they break it down into some really interesting numbers. For instance, living to age 97. Now, for some that I meet with, they look at me and they're like, I don't want to live to 97. But I'm having enough trouble now. I think it was Mickey Mantle, in fact, that had that famous quote, I would have taken better care of myself if I knew I was going to live this long, right? So one of the things that goes with living longer means that we're going to have to be able to live longer on our money in retirement as well. And this is one of the, there was some surprising stats actually for me on one of them. The average retirement age is age 63. According to this recent study. And that's when, and people are, of course, can start collecting Social Security at 62. So to see that people are retiring at 63, now whether they start Social Security then or a little later, hard to say. The average, though, might bear that out. So here's what that means basically is this. If we're living longer, that means we retire and we cut off that income, and whatever we've saved, we're going to have to live on for maybe 30 or 35 years. That is a long time to be making sure you can save, especially when the average amount in a 401k today is only $92,500. Let me tell you the obvious, okay? Let me say to you that $92,000, less than $100,000 is not going to be enough to support your lifestyle over the next, say, a 20-year period, let alone 30-year or more period. So this is something to keep in mind when you're looking at retirement. When we're crunching numbers, when people come in to see me, that's one of the areas we're looking at is how long is that money going to last? Am I going to be able to retire when I want to? We look at your income, we look at your expenses, we look at assets, we look at liabilities. All of that together to determine what your financial future is going to be. What about inflation, rates of return on your investments, cost of living increases on Social Security or a pension if you're lucky enough to have one of those. All of that in together and doing up a plan. And here's another big one that we're going to get into quite a bit today, and that's taxes, right? If you're going, what are you going to be paying in taxes in retirement? Are you going to have to pay tax on your Social Security benefits? There's a good chance you will. How about on your when you're pulling that money out of those retirement accounts to help supplement your income? What are you going to do there, all right, as far as helping to minimize your taxes? I'm going to throw out an offer for you. 10 callers, first 10 callers to my office this morning. The number is 615-376-5325. If you would like to see what your financial future looks like, I'll be able to help you with that. Just as I was just talking about, just as I talk about in my book, we do it the same in the office, do this each and every day with clients. It is looking at what you have for income, what you have for expenses, what is that lifestyle, in other words, what does it cost every month, year in, year out, to be able to maintain your standard of living and quality of life. All right, we're going to look at that, and then what kind of, income you're going to have now, and income you're going to have in retirement, your expenses again, assets, what do you have saved up? Do you have rentals? Do you have just, the money in your 401k or other retirement accounts? What kind of liabilities? Do you have any debt that you're going to have to pay off? We look at all of that, and then we put a plan together. When do you want to take Social Security? We look at when the best time to take that would be. We talk about Medicare and the expenses of healthcare costs in retirement. This is one of those things that is a lot more than what people realize. I've talked about before in the show, and we may get into it a little bit today as well. So all of that you get with this free retirement income analysis, a full comprehensive plan. Call my office, 615-376-5325. Tess is standing by. She'll get your information. She'll send you out a packet. She'll give you a checklist of things to bring in with you to your appointment with me so that I can help you see your financial future and see, based on what you're doing, is that the financial future you want? Or based on some strategies I'll share with you how to improve upon it as well. And when you come in to see me, I'll also give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. All right. Today, I have my good friend and special guest, Dr. Friday, is in the house, and we're going to be talking about taxes. We got a lot. I mean, and this is kind of a timely thing because of taxes in the news now with this new tax proposal that they're talking about.
Right. Well, probably need to remind everyone, if you filed an extension, you have till October 15th.
There we go.
Okay, so 16 isn't over yet, and you really need to do some serious planning for 17, because once the holidays, when you try to get into these guys' office, I mean, when the holiday season, doing those Roth conversions and all that, it's a last-minute thing. So you really need to have the planning. But yeah, Trump is in the news again.
Yes. He stays in there.
He does know how to get. I really need to get his PR person. It'd be great.
But he's good. Yeah, he's pretty good at that, isn't he?
He's good at getting his name in the press, one way or the other. But had some interesting conversations this last week. I'm sure you have too. When he put out his idea of what would be some strategies to help reduce potentially, mainly I think a lot of people are always looking at what's going to do for me. What is it going to do for me? And I sometimes think that people need to look at, is it better to have the money in the hands of the taxpayer or in the hands of the government? We all know that the government is the largest employer, and let's be honest, no matter what you can say, they are not good at managing money. I mean, I had a friend say, well, just they'll pay off the deficit if we can pay them more money. Had they done that? I mean, that hasn't happened. All they keep doing is borrowing. So to me, it would be better for the taxpayers to keep the money and apply it towards moving money, because most people, if they have money in the bank is going to loan it to small business owners or real estate. It's going to move, right?
Yeah, exactly.
So his suggestion is basically to reduce some of the tax brackets and mainly increase the standard deduction. That's
put more money in the pocket of people that can make the use of it. And this is the other part. When you're looking at taxes, when you're looking at where your tax dollars are best put to use, let's face it, the government does not create jobs, okay? The government does not improve our economy. What the government does is provide us services that we pay for, and usually overpay for relative to what we're receiving.
Well, that's true.
So yes, if we're, and one of the things in breaking this down, for the average person even, this is going to, when I look, for instance, my client base as an example, and I'm looking at, say it's an average couple age 65, you're looking at $23,400 combined standard deduction and exemptions today. Under the new plan, that would go up to about $38,000, because they're talking about raising a standard deduction from what is now $15,300 approximately up to $30,000 for that couple. That's a huge difference. That's an extra almost $15,000 that you pay no tax on. So, and
I'll jump in really quick. The only nice thing about that is because a lot of people, especially as you get closer to retirement, are not having huge mortgages. So the ability to itemize is getting harder and harder for them, but yet they're still giving to charity and all that. So by upping that, this way you really are dealing with people that have really big mortgages or huge contributions. They've already eliminated medical pretty much anyways for people to write off. So I like the idea of taking us from the 15,300 as a married couple, as if you're over the age of 65, to 30,000.
I mean, looking at the numbers, this is the other thing. When I'm working with clients and we're talking about, we're talking about taking money out of an IRA or a 401k or that kind of thing. How can we minimize taxes? This is another area where this can be a big help. If that were to, if that gets through, and we're talking about raising that standard deduction and the exemptions that we would have, sheltering a lot more money at the lowest end, by the way, so that benefits everyone with regard to taxes. That's going to be that much more money than zero tax on. So we're talking now potentially $38,000, a little over $38,000 that you pay no tax on compared to 23 now. $15,000 at zero tax. Right there, that's a savings of about $1,500 across the board at the current rate at 10%. They're talking about collapsing the 15 and a 10 together into 12. When you raise that standard deduction, that works out again to the advantage, because on the $18,650, and I think they're going to be doing it now up to the whole, what would be $75,000 would be at 12%.
Right. After,
now this is taxable income, so that's after the standard deduction and exemption, or standard deduction and exemption part. So if you get $38,000 there, that means you're only going to be looking at about, let's see, well, $38,000 goes away. It means you can also shelter up to, or you can pay. You could go up from $113,000 now. Ultra Max, I know this is. I need to break this easier. So numbers for me, they're going around in my head. But let me bring them down here for you. So that what it means basically is this: if you've got $113,000. A lot of times what we're trying to do is we're trying to reduce down the by pulling money out of your 401ks and that, and stay in the 15% bracket.
Right.
Because you hit 70.5 and you start to have to take required minimum distributions out. The government says, right? IRS says, okay, you've got that tax deferral. Now you got to pay us the taxes. Well, a lot of times what happens is if someone has large required minimum distributions, it's going to pop them up into a 25% bracket, and that means the money they're pulling out is going to be taxed at 25%. So this is a big deal. If you think about it, over each and every year, you're paying an extra. Now think about this. Instead of 15% tax on that money, you're paying 25% tax. That is a 67% increase in your tax rate.
That's
all right.
crazy.
So if we can do things before you reach 70.5, such as taking advantage of that higher ceiling to pull money out at that lower rate, reduce down the amount you have in your retirement accounts, thus reducing down your required minimum distribution, and thus, of course, keeping you in the 15% bracket for life. There's a great way. Well, now would be the 12% bracket, so it's even a bigger savings potentially. So there's some great things here on taxes, and this is where it's so important. You're talking literally hundreds of thousands of dollars over your lifetime more in taxes through poor planning. I see it all the time.
Yes.
We talk about, people wanting to pull money out and not understanding how that works. All right. We're going to get into this, and I'll try to break these down a little bit more.
so
you can follow. I know. I love saving money, and I'll tell you, when we talk about tax planning, we want to make sure that the only loser in this is the IRS, not you. All right? Join us here. We'll be right back on the Retirement Report.
This is a Storm 5 HD weather update. Sign up for Weather Call at newschannel5.com.
Sunshine, blue skies, and all-around beautiful weather across the mid-state. Temperatures, that's really been the key difference. Cold front that came through yesterday has very efficiently cooled us down. It's also ushered in drier, more comfortable, more seasonable air. So it's going to feel like fall as we round the corner to the first few days of October. And that means the satellite and radar is expected to remain fairly quiet for the next few days. It'll be a dry pattern as we head into October as well. Here's a look at temperatures across the southeast. Everyone enjoying a bit of a break from that heat, especially for our friends to the north and northwest. And of course, current conditions right here in Nashville. Overnight tonight, we will be cooler than we were Thursday morning. So Friday morning feeling a little more comfortable, a little more crisp, 55. Friday afternoon, same thing, a little more comfortable, a little more crisp. 78 for your top temperature to end this work week. We will ride the upper 70s all the way into the weekend. Temperatures near 80 by the first part of next week.
Are you looking for an easy way to do your taxes? Dr. Friday here. I can help you keep more of what you've earned. With over 20 years of experience, I can help you minimize your taxes. I'm an enrolled agent. That means I'm licensed by the Internal Revenue Service to represent you. Whether it's your personal or business returns, I know the ins and outs of the tax code. I'm on your side. Learn more of what I can do for you by calling the number on the screen or go to drfriday.com.
The time has come to enjoy your golden years, but have you saved enough?
I'm Hank Parrott. Don't just survive in retirement, thrive. Call me today at Estate and Financial Strategies or tune in for the Retirement Report each and every weekend on News Channel 5+.
You've been smart and saved for your retirement years. But now what?
It can be an overwhelming puzzle to see the big picture, but it doesn't have to be. I'm Hank Parrott of Estate and Financial Strategies, and I can help you thrive in retirement, not just survive.
Estate and Financial Strategies can help you maximize your wealth while minimizing your risks. Here's what we mean. To thrive in retirement, you need to maximize your Social Security benefits and your returns on investment and minimize taxes and the effects of inflation while planning for health care costs and increases in the cost of living.
Yes, you can thrive in retirement and not just survive, but you have to take that first step. Be one of the first 10 callers to my office to receive a comprehensive financial plan at no charge. This is more than just a free consultation. It's a full, comprehensive financial plan. Believe me, you can thrive in retirement. Don't just hope to survive. Good morning. Welcome to Retirement Report. I'm Hank Parrott, your host, and with me, my good friend and special guest, Dr. Friday with Dr. Friday's Tax and Financial Services. She is in Brentwood, Tennessee, and she is the tax expert for small business owners and for individuals. And one of the things that we get into a lot when we're counseling and working together with clients is what to do with regard to taxes coming out of retirement accounts. Yeah. It's one of the biggest things that I think people misunderstand is when you're, they're saying, oh, I've got all this money, I've got $500,000, therefore I can go do all these things. I can pay off a mortgage, or I can go buy a new house, or I can do all that. Well, guess what? If you're not careful, you could easily, if you pull that whole amount out as an example, $500,000 in 1 year, and you went to go do these things, you'd probably be looking at having only about $250 to $300 of it left after taxes. In other words, more, potentially, in fact, it would be probably about half of it gone between the tax rate you would be in, a penalty, well, depending on whether you're self-employed or not.
or self-employed or any of those. But yeah, you're looking at 40% minimum coming out of that account. And I mean, that's like taking almost all the growth you've had and just you should have thrown in a shoebox, because you would have had no growth at all almost from most of the time. Because
and think of it, if you're looking again at $500,000, 40% tax, that's $200,000 in taxes. That leaves you $300. So if you look at that $500 and think it's only $300, as depressing as that might be, here's something else. If we do things correctly, we could reduce that rate down. We can reduce it down dramatically, at least to 15%, let's say. Now, not that we want to pay 75, but that's certainly a lot better than paying $200,000. Right. All right. So these are the kinds of things, and if we spread it out and we do it correctly, we can reduce those taxes down. I've got clients, depending on what your lifestyle is and what you need to live on, and a number of other factors. We've got clients that are basically able to pull money out at less than 10% even out of their retirement accounts. It's all how you structure it. All right. And the other thing is, when you, even on the higher income side, if you're going to be up in a higher brackets later because of required minimum distributions, there are things that we can do now that can reduce your taxes. Again, just that jump from 15 to 25, that's a big jump. And
I was going to say that really takes going in early, though. I mean, you don't hit retirement at maybe, okay, I'm retiring, I'm 67, I'm going to go see Hank now. Right. That kind of thing makes it so much harder, because then you only have a couple of years possibly to do anything for RMDs at all, and you don't have the ability to change a lot of lifestyle, where if you come in before you're hitting retirement and you have the ability to plan, what are my expectations into retirement, what will my taxes look like, do I need to start doing something now? I mean, there's a lot of maneuvering, and it's huge the amount of money I've seen you save people when they do it in advance.
This is one of the areas. I mean, I always say to people, if you're, when you're saving for retirement, or when you're preparing for retirement, or even if you're in retirement, yes, the more we can plan in advance, the more benefit I can help you with. All right, the more things that we do, the more when it comes to reducing down the taxable part of your retirement accounts, as an example, possibly looking at Roth conversions. There's ways that we can implement a lot of that. The other part, though, is it's never too late. All right, better to get a plan in place, because this is the other thing that we see too often, where someone comes to see us after they've made that mistake. They've taken money out. They've already decided on Social Security. When I've seen people start taking Social Security at 65, and if they would have just waited another year, the difference it would have made to them as far as their income and that for their spouse, huge difference. And again, that's money you can't get back. So if when you're looking at making those decisions, it's a good time to sit down with someone and go over that. When I sit down with people and show them, we look at basically if you take now versus waiting, and whether that's at 62 versus 66, or 66 to 7, depending on your date of birth, or to age 70. We've crunched the numbers and show you, if you make your decision, think about this. This is the way I look at it. Imagine that every decision you made that was going to impact your life, that you could see what the result of that decision would be 10 or 20 years down the road. Would that help you make a good decision?
Yeah.
All right, that's what we're doing. Or I'm running it for you both ways. I'm saying, okay, you made the decision to do it at 66. This is when I'm going to start taking it. All right, let's look ahead 20 years and see what the impact of that is. What if you had waited to 70? Let's make that decision, and let's look ahead 20 years and see what that looks like. We can run those numbers for you, and I can show you your financial future based on the decisions you make today to help you make better decisions.
Right.
And to show you ways that you can improve on these things, how to get more money, how to keep more money in your pocket, how to get more money out of Social Security, how to, and this is where, you know, getting more money out of your retirement account's the same thing. When you're talking about that difference in taxes, that's huge in terms of how much you get to keep versus how much goes to the IRS.
Absolutely, because I mean, when you read all of this from the papers and all the different things, the one thing that basically is saying is if we're not taking care of ourselves, the problem is there's a large number of people in society right now that basically are making no plans. They're not figuring out how they're going to retire. They're never going to apparently retire. They're never going to save money, and they're not. So what's going to happen with them is going to affect all of us, because no matter what, even if we're good planners, the fact of cost of medical care is going to go up, all these things, because we have such a large number in the population that doesn't. The one thing I think I liked about the good old days with the pensions and all that, everybody had something to retire on. Now we're expecting people to take it in their own hands, and the only thing they're doing is Social Security and Medicare because they have to. It's a mandate.
Right. This is one of those areas when you're looking at, as Dr. Friday was saying, this is one of those parts about our nation and some of the changes that are going on. We're seeing people, when we're looking at numbers, I just shared about, I think it was 92,500 is the average in a 401k currently. Well, here's the other thing. About 26% of respondents to the survey had less than $1,000 saved for retirement. I've shared this before. This is that there are all kinds of stats and studies out there that are talking about the lack of savings for the majority of people, and talking about numbers where you're talking 50% of people have less than 50,000 or 64. Almost 2/3 of, think of that, 2 out of 3 people have less than 50,000 saved for retirement. All right, what is it now when you look at that kind of statistic and you think in terms of, well, I've had people say, I'm just going to work, I just have to work forever.
Exactly,
right?
I've had that said
now,
too.
When you want to work forever, and there's a lot to be said for that, because I've seen clients retire a little too early and go through kind of a lost period of not knowing what to do with themselves, and feeling depressed even, and you know, just this lack of purpose. So make sure that, you know, if you're going to be, you know, when you're retired, that you've got that part in place as well. I know for me, I want to work forever. I have many clients that feel that way because they love what they do. So that is my retirement. That's fun, right? I get to do this. I get to do this. It's not that I have to do it.
I mean, if God forbid, some reason you couldn't do that,
health comes into play.
Also made some steps so that would take care of itself as well. And that's the problem, that, you know, one saying I'm going to work forever, I'm like you, I have no plan. And my sister, she got her Social Security statement the other day, and she's like, well, if I retire at 66 and a half, I get $1 amount, but if I wait till 70, is $1,000 more almost on the thing. That's a huge dollar amount. Well, she doesn't have any plans on necessarily retiring, because if she retires what she's doing, she's coming to work for me anyway. So there'd be no real retirement, but that was huge. I didn't, you know, I haven't looked at mine in a long time, so I didn't realize it was a fairly healthy jump.
You're looking at a 32% increase. It's basically about 8% a year. So if you wait for, say, someone at 66 versus age 70, a 32% increase in your, so you could be looking, if you were going to get $30,000 a year, you'd be getting $40,000 a year. Right. Yeah, you'd cap it out most likely for those, you know, depending on what your income levels are and the rest. This is one of those areas too that for Social Security, depending on your income, for most people, Social Security makes up somewhere between 40 to 50%. And here's that thing again about how we have a large number of people, again up in that 2/3 range, that Social Security makes even a bigger number. And I'm trying to think, I think it was like 85%.
But going back to that tax planning,
they're going to have, in other words, be independent. It's going to make up more than 60 or 70% of their income. They're going to be depending on Social Security for, and then they've got to get savings to make up the difference, or work.
What savings?
Yeah, what savings, right?
Well,
and it's a lack of that.
Quick, that's when we talk about planning. If you were to put it off, in my sister's case or whatever, she put it off to 70, and she could do more conversions of that 40,000 or whatever, you know, keeping her in that 15%, she could take more of her pension and retirement in her case, and rolling it over into the Roth or whatever, and having that extra money still growing on this side. So, you know, it's not like she has to have it. So
this is one of the things this is where planning comes in again. All right, a good planning is going to help you figure out for your specific situation. And when we come back from this break, I'll give you another offer to allow you to come in and get that personalized plan for yourself to see what decisions are going to be best for you. All right, but first a quick break. Join us here. We'll be right back on the Retirement Report.
The time is